Hello, everyone. My name is Matt Vanderloo, and I'm a principal and the CEO here at SVA. I'd like to welcome you to our webinar, Wisconsin's Economic Outlook. Before we get started, I wanted to take just a couple minutes to say a few words about SVA. Our vision is to remain an independent professional services firm, and our goal is to continue serving the same clients we have since 1974. Closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset over these last 50 years is that when you're a business owner, your business is more than just a job. It's a part of who you are and something that's going to affect you personally. So it's important that your advisors are not just about compliance, but that they're working collaboratively with you in a consultative way. And that's our goal. This webinar and others like it are just one small way in which we do that. For today's webinar, please send in your questions through the chat box. If a question is related to the current discussion, we will try to address it right away. Otherwise, we'll have plenty of time for Q&A at the end. It's a pleasure to welcome back Dr. Stephen Deller as our speaker. Dr. Deller is a Vilas Distinguished Achievement Professor in the Department of Agricultural and Applied Economics at the University of Wisconsin-Madison and a Community Economic Development Specialist within the UW-Madison Division of Extension. He is formerly the Interim Director of the Center for Community and Economic Development at the Extension. His work is in the broad area of community economic development with a focus on smaller communities and rural areas. He's co-authored the textbook Community Economics, Linking Theory and Practices, and has co-edited 5 books, each focusing on community, rural, and regional economic development. The most recent is a co-authored book entitled The Fiscal Health of U.S. Cities. Some of his current work has explored the community economic impacts of mining, women-owned businesses, manufacturing location decisions, local foods as a community development strategy, and the role of taxes and public services in community economic growth and development. We are very excited and very fortunate to have him join us today, and we look forward to hear his follow-up to the presentation he gave us 2 years ago. Dr. Stephen Deller.
Thank you for the very kind introduction. Good afternoon, everyone. What I'm going to share with you today is kind of 3 things. One is, what is some of the current economic data telling us about the national economy, with a little bit of focus on Wisconsin where I can. And then really kind of focus on where does the near-term economy look like? What's the economy going to look like over the next 6 months, over a year? This was going to be the focus of my comments this afternoon, but these economic forecasts are from January of 2025, and given what's been happening over the last couple of weeks, they're already out of date. So I will still review that, but that won't be the focus of my discussion. So when folks were kind of reflecting on 2024 and kind of looking at 2025 as the new year rolled in, there were a lot of headlines in the media that were pretty optimistic. The Wall Street Journal, the world economy looks to accelerate in 2025. Little caveat there about maybe higher tariffs. The OECD, which is a European focus, the economic outlook, the global growth to remain resilient despite some risks. Goldman Sachs, U.S. economy is expected to beat expectations in 2025. So the outlook at the turn of the new year was really pretty optimistic. We were thinking that 2025 was going to be really kind of a pretty good year. But these are headlines from the past couple of weeks. The Economist here, this is the current cover of the current issue of The Economist. It showed up in my mailbox a couple of days ago. And The Economist, if you're not familiar with it, is a British news magazine, and it's pretty conservative. It's conservative kind of in the tradition of Ronald Reagan type conservatism. And I think what I wanted to point to is kind of the subtitle there, the revised economic outlook. So the forecasts that were kind of done in December 24, January of 2025 that I'll cover with you, we got to take those with a grain of salt. these are some of the headlines that have been coming out. The economic outlook worsens as polls find disapproval of Donald Trump's economic policies. Some of the big companies, some of the big U.S. companies like Walmart, are saying that they're not expecting their expectations to be as good. As we were waiting for the webinar to start, Dick's Sporting Goods just put out that they're putting out warnings about their earnings in the coming year. Reuters reports U.S. business activity is stalling. Consumers' inflation expectations are starting to surge. It's kind of become a running joke about the price of eggs, but I think that that's kind of a kind of a touchstone, if you will, as to how people are feeling about prices. Disappearing U.S. data dims economic outlook. This is something that is kind of close to me because about a month ago, a lot of the traditional federal data sources that folks like myself and my colleagues like Tessa Conroy and others, that we use a lot, all went dark. So, for example, if you ask me, what is the unemployment rate for Milwaukee compared to, say, Chicago, the traditional websites that I would go to and grab that data went dark. And the reason they went dark is because of executive orders that were coming out of the Trump administration that really kind of threw up a lot of concern about what was available on the federal websites. Some of that data is slowly but surely starting to come back, but this is kind of an indication of some of the chaos, if you will, that has been occurring over the last 6 weeks, 2 months, 6 weeks. These are
Dr. Deller.
Yes.
Can I interrupt you real quick? I'm sorry. Can you turn your camera on for us?
Sure. Please do. Camera on?
Not yet.
Not
at least
yet.
on my end.
Here we go. Come on, come on. Oh.
There it is.
There it is.
Thank you.
Sure. There's really kind of a couple of themes that are coming through the more current headlines. Things like uncertainty, chaos, confusion. That some are actually saying that we're going to be heading into a recession. So there's been this kind of change in tone from the start of the new year when people were kind of optimistic to a much more pessimistic tone. Indeed, just about a week ago, the Atlanta Federal Reserve Bank basically redid their economic forecasts, and they were projecting a quarterly growth rate of about 2.3%. They actually have revised it, and now they're forecasting that the GDP, gross domestic product, is actually going to contract by 2.8%. So we kind of went from the glass is half full to the glass is half empty. I don't know if you've been following the stock market over the last couple of days, but there is real instability on what's happening to the stock market. Indeed, the Standard & Poor's 500 posts the worst day of 2025 after Trump forges ahead on tariffs. In essence, Trump said, okay, we're going to impose our 25% tariff on Canada and Mexico, and the stock market went into a free fall. Okay. And recently, I mean, this is just last Friday, that the stocks are continuing to slide on, and volatility is exploding, basically because Trump went on to Fox News and was asked point blank, what's the likelihood of a recession? And are you worried about it? Are you doing anything to prevent a recession? And Trump basically said, well, we're in a transition period. That sent kind of shockwaves through the stock market. The stock market right now is actually down, not as bad as it was yesterday, but it's still down. Okay. Now, what are some of the Trump risks? This is the concern that even with the optimistic outlook at the start of the new year, there were, the headlines were kind of prefaced with 2025 looks good. However, there are some risks. Those risks are around the new administration, and there are three risks that have been identified. One is tariffs. The second is the mass deportation, and then policy uncertainty or chaos. Let me talk about each one of those a little bit. This is kind of a historical picture going back over 100 years of U.S. policy related to tariffs. And you can see that 100 years ago, we had a lot of tariff activity, particularly through World War I and up into the 1920s. We saw a tremendous drop on the number of tariffs, and the 1920s was actually a pretty good time period for the U.S. You can see that we started to reintroduce tariffs. And then, right as we started to enter the Great Depression, before the Great Depression became the Great Depression, actually after the stock market collapse, President Hoover signed into law the Smoot-Harley Tariff Act. Essentially, if it looks like we're going to go into a recession, we're heading into a recession, let's put up trade barriers to protect the economy. It backfired. If anything, that one act probably took what was going to be a serious recession and turned it into the Great Depression. Putting tariffs into place is generally bad for economic policy. You can see that in the post-World War II period, we started really moving towards low tariffs, and starting with the Reagan administration, we've really cut tariffs down. We've essentially opened up to free trade. Now, when we look at economic growth patterns in a few minutes, some of the strongest economic growth that we had was during this time period. You can see that Trump's first term, he did impose a couple of tariffs, primarily on China, to kind of make a statement or two. But what he's proposing now is to kind of go back to where we were at the height of the Great Depression. And this is why the markets are so skittish. They're seeing that, and they're saying this is not good for the economy. That's what the stock market is telling us. Okay. Now, if you look at exports in terms of U.S., you can see that starting in the early 1980s, when we really went into this low tariff period, you can start to see that our exports out of the U.S. really started to take off. So the blue line is exports, the orange line is imports, and you can see that we're importing a little bit more than we're exporting. That's the trade deficit. That's what the current administration is kind of zeroing in on. But we've kind of been a net importer for decades. I mean, you have to go back to the 1950s when we were a net exporter. The point being is that about 11% of the U.S. GDP is tied to exports. So exports is becoming a very important part of our economy. It's also becoming a very important part of our input supply chain. If you can remember kind of the COVID period, and there was a spike in inflation coming out of COVID, a lot of that was driven by what I refer to as bubbles in the supply chain. In essence, international trade shut down, and that created bubbles, if you will. And those bubbles kind of resulted in demand outpacing supply, and that led to inflation. So it's not just aggregate levels, but it's kind of how our input supply chain is put together. Just recently, the premier of Ottawa, not Ottawa, I beg your pardon, Ontario, the Canadian province, I think they're called premiers, whoever the head of the government there is, yesterday levied a 25% tax on all the electricity that is coming into the U.S. Predominantly, most Canadian electricity that's generated generally through hydroelectric is going into Minnesota, Michigan, and New York. Levied a 25% tax on it as retaliation against Trump's policies. And this morning, Trump announced that he's going to levy a 50% tax, a 50% levy on steel and aluminum coming out of Canada, and also on Canadian auto parts. That will greatly disrupt the U.S. car manufacturing industry. Okay. Now, what about Wisconsin? Wisconsin exports about $27.5 billion. That's about 6% of Wisconsin's GDP. And it's been steadily increasing over the years. Our biggest trade partners are Canada, Mexico, and then China and Germany. And China and Germany, it really kind of drops off. Specifically, it's a little bit clearer in this graph. This is 2024. And you can see that our biggest trading partner for exports is Canada at just short of $8 billion, followed by Mexico, which is about 4.2, and then it drops off to Canada, to China, Germany, Australia, all the way to Chile. We're one of the, I didn't put it on here, but one of the fastest growing export markets for Wisconsin is actually Vietnam. If you look at what we're exporting, we are very much of a manufacturing state. A lot of the exports is coming from manufacturing. We like to think of ourselves as a dairy state, and we are, and we take great pride in that. But in terms of exports, dairy is kind of down the list a little bit there. So when we start looking at the industries that could be affected by tariffs and any retaliatory tariffs that are imposed on us, we can start to see which industries in Wisconsin could be negatively affected by this. Okay. Now, this is a survey that the Wall Street Journal does. It's a service that they provide. And this is where I'm getting my economic forecast. This is a question that they asked 70 or so different entities that do economic forecasting. And I'll explain a little bit more detail below later on. They asked a question in their October 2024 about, former President Donald Trump has proposed imposing broad tariffs on imported goods. Okay, that's what we're going through now. The question was, do you think this policy will affect employment in domestic U.S. manufacturing within 3 to 5 years relative to no tariffs? And this is the response. About 16%, 15.9% responded and said, oh, this is going to increase manufacturing employment in the U.S. 1 in 4, 25% said it's going to stay the same. It's not going to affect manufacturing employment at all. Over half, 59%, said that these tariffs will actually have a negative impact on U.S. manufacturing. And if you look at the auto industry and the way that the supply chains are structured, the 25% tariff and a 50% tariff targeted at Canada could greatly affect U.S. car manufacturing. And that's just one example. Okay. Now, what about immigration? Mass deportation. This is of a particular concern because so many, Wisconsin has been experiencing a labor shortage for a number of years now. And many of the jobs that are being difficult to fill are not particularly good paying jobs. They're not high paying jobs. That's why there's a labor shortage in those sectors. And immigrants tend to be very interested in taking those jobs. So there's a question here as it comes to Wisconsin as to what impact mass deportation of immigrants could have on the dairy industry. An analysis that I did for Wisconsin Politics said, hypothetically, what if 1,000 undocumented immigrant dairy workers left? Okay, the dairy industry, the farming dairy industry, lost 5,000 workers. The impact would be about 14,000 jobs, and indeed about $4.5 billion in industrial sales. That's about 29%. So if you look at the importance of Wisconsin dairy, farm dairy to the state's economy, if you took out 5,000 undocumented workers, that could impact up to 29%. The dairy industry and a lot of other industries, the construction industry, the food industry, restaurants, things like that, have become highly dependent on a lot of these immigrants for labor. And a mass deportation of those will have a disproportionate impact on certain industries. Okay. Now, this is from Friday. This is the New Yorker. And again, I cut this because of the way that it kind of summarizes. Will Trump uncertainty knock the economy into a recession? There's only so much public chaos that household businesses and financial markets can take. So this uncertainty and this chaos, the tariffs are on, the tariffs are off, I'm going to retaliate in this way, that creates a lot of chaos, and that leads to uncertainty. This is an infamous quote from Donald Rumsfeld when he was Secretary of Defense during the Iraq War. And when he said this, a lot of people said, "What gobbledygook?" But look at what he said here. And this again in relation to the Iraq War. There are known knowns. There are things we know we know. We also know that there are known unknowns. That's to say, we know that there are some things that we do not know. But there are also unknown unknowns. The ones we don't know, we don't know. And people looked at it and said, "What kind of gobbledygook is that?" What he's talking about is the difference between certainty, risk, and uncertainty. Okay, certainty is we know it. Okay, we know we have to pay taxes. We know that there are certain regulations that, when we run a business that we have to follow. There's risk. There are some things that we don't know, but we can make a really good educated guess. Do we think interest rates are going to go down, go up, or stay the same? We don't know, but we can make a really good educated guess. And that's what a lot of these economic forecasts are trying to do, is to shed some light on what we think is going to be happening in the future. Uncertainty is when we don't know what's happening. We simply don't know. Now, the problem, though, is that as Ben Bernanke, I should say former Federal Reserve Chair, uncertainty in itself can depress investments and hiring as businesses scale back plans until they have greater clarity. If you're a business owner and you're thinking of making a major investment, and there is suddenly a lot of uncertainty in what's happening in the economy, what people will do is they will hunker down. They won't make that investment. Consumers won't make that new major purchase. When people start to hunker down, essentially demand drops, and that can trigger a recession. So this uncertainty that is coming out right now is really a major source of concern. Okay. Now, what's happening to gross domestic product and personal consumption expenditure? This is going back to right after World War II. So we got kind of a long-term plan here. And this is real, so the effects of inflation are taken out. Real gross domestic product is the blue line. You can see pretty strong growth. Particularly, there's a bit of an uptick there after the Reagan years, or kind of during the Reagan years. That's when we started really kind of opening up international trade. So we can kind of see a tick up there in growth. We can also see a tick up in personal consumption. You can also see some economic downturns. You can see the Great Recession, the late 2008, 2009. You can see the downtick there. You can see the impact of COVID and the bounce back from COVID. But what I want you to see here is that green line. That's the share of gross domestic product that's coming from consumption, personal consumption. It has averaged around 70% and trending above 70% for decades. Our economy is a consumer-based economy. As the consumer spends money, that drives the economy. Okay, so if consumers start to back off and they decide they're not going to make that purchase, or they're going to tighten their belts a little bit because they're not sure of what's happening in the economy, or they're looking at the stock market and they're looking at the retirement fund, they start to pull back. Because we are a consumer-based economy, when consumers pull back, that can trigger a recession. Okay, now this is economic growth right before COVID, during COVID, and then post-COVID. And you can see that COVID, this is the closest that we have ever come to turning the economy off and then turning it back on again. Okay, we've never experienced anything like that before. I mean, we have to go back to 150 years ago before we can experience anything like this. But notice that after the kind of the recovery, we've kind of hit this stable period of kind of growth. This, I think, is a little bit a cleaner way of looking at it. This is taking this is kind of okay. We're out of the COVID shock. We're back kind of more normal now, and through this period of 2022 to 2024, for the national economy, we were growing the gross domestic product was growing at about 2.9%. That's pretty good. Real personal consumption expenditure was about 2.7%. That's pretty good. There's no indication here of any kind of warning flags. There's kind of natural ups and downs a little bit, but this is the kind of trends that people were looking at the turn of the new year when folks were saying, hey, 2025 looks like it could be a good year. This is the kind of data that they were looking at. Okay. Now, what about unemployment? This goes back to 1976. That's as far back as the Wisconsin unemployment data is collected. And there are a couple of things that you can see here. The blue line is the U.S. unemployment rate, and Wisconsin is the red line. Notice that Wisconsin is almost always below the national unemployment rate. There was only one time period in the early 1980s when Wisconsin was above the national average, and that was the farm crisis and the manufacturing crisis. Wisconsin was hit with a double barrel. That's the only time period. Otherwise, we're almost always below the national average. There's another period in the Great Recession where we were up above it for just a little bit. You can see the Great Recession. You can see COVID. But look at the more current time period, okay? If you look at the average monthly unemployment from 1976 up to 2024 for the U.S., the average unemployment rate was just over 6%. Right now, from July 2022 up until January of 2025, it was about 3.8%. That's a pretty low unemployment rate from a historical perspective. Wisconsin, that historical over that whole time period was about 5.2%. Now it's just a little bit below 3%. Okay. We got a pretty low unemployment rate. Now, economists, there will always be some positive level of unemployment because the economy is always in a state of churn. There are always businesses that are closing, contracting, expanding, opening. There's always a state of churn in the economy. There will always be a certain level of unemployment. Now, economists sometimes refer to that as the natural rate of unemployment. What is that kind of full employment level of unemployment, if you will? And, you put 10 economists in the room, you're going to get 20 different answers. But it's around 4%. If the unemployment rate is below 4%, that's generally an indication of a good labor market. If the unemployment rate is above 4%, then, maybe we need to think about it. But by any indication, looking over the past year and a half, 2 years, the unemployment rate's been really good. Again, that's the kind of indication that a lot of folks were looking at 2025 as being a good year. Okay. Now, this is sometimes referred to as the JOLTS data, and it's looking at job openings, which is the green line, the number of unemployed, which is the red line, and then the ratio of the two, which is the number of openings to the unemployment ratio. If the red line, unemployment, is above the green line, the number of job openings, that means we have surplus labor. We have more people unemployed than we have job openings to fill those. Okay. If, on the other hand, the green line is above the red line, okay, that means we have more job openings than we have people to fill those jobs. We have a labor shortage. Now, you can see this is the U.S. You can see the Great Recession. That ratio really widened. There's a lot of unemployed people for the number of jobs. But look at about 2017, 2018, suddenly we have a lot more job openings than we have unemployed people to fill those jobs. That black line is above 1. That's a labor shortage. Okay. And then COVID hits, we recover. But from a national perspective, we have a labor shortage. Now that's starting to tighten up a little bit. Okay. We're getting back to kind of more of an equilibrium, if you will. But this is going back to that immigration work. Now let's look at the data for Wisconsin. The Wisconsin data doesn't go back as far as the national. It starts in 2011. Notice that in about 2016, the number of new job openings was greater than the number of unemployed. Okay, so that black line, that ratio, is above 1. That's indicating we got a labor shortage. Then COVID hits, and then we recover from COVID. So right now, Wisconsin has a structural labor shortage. We don't have enough workers for the number of jobs that we've got. It's starting to come down a little bit, okay? But unlike the national average, we still have a structural labor shortage in the state of Wisconsin. But this isn't just because of COVID. We were having this labor shortage way before COVID ever hit. So this is where immigration policy really starts to come into play. One of the ways that we've been able to address this inherent labor shortage is to encourage immigrants to move into the state of Wisconsin and take jobs. So immigration policy is really very, very important for the state of Wisconsin. Okay. Now, labor market trends, separations and quits. I'll just spend a second on this. And move on a little bit. This is the number, the black line is the number of people that are quitting their jobs. The blue line is the number of people that are essentially being laid off. And what I want to show is this kind of post-COVID and then more recently. Post-COVID, you can see that quits was trending up. A lot of people were rethinking work, and they were looking for other employment opportunities. So you saw that move upwards, but you notice that it's reversed down. It's starting to come back down to where it has been historically. So a lot of that, like kind of labor market shock because of COVID, it's kind of played its way out. Now, what about inflation? There are two measures of inflation here. It's the Consumer Price Index, that's the CPI, and then the Personal Consumption Expenditure Index. Okay. Both of these, they tend to track each other. The Personal Consumption Expenditure Index is a little bit less volatile than the Consumer Price Index. The Federal Reserve Bank, when they look at inflation, they prefer the Personal Consumption Expenditure Index, the orange one. They like that, and I can explain why a little bit. But the Consumer Price Index is what's generally written into law. So, for example, if you're getting Social Security and there's a cost of living adjustment, it's based on the Consumer Price Index. Okay, but if you look at kind of historical inflation patterns, the current peak that we had in June of 2022, relative to historical patterns, was actually not that bad. The worst inflation that we've had since we've been able to track this data was actually post-World War II, with peak inflation of 20% in March of 1947. There's also an inflation crisis in the 1970s, from 1973 to 1982. Peak inflation was 14.8% in March of 1980. And then the current kind of spike in inflation, where the peak again was just over 9%. So from a historical perspective, this 9.1% inflation it's not setting records. Yes, it's high, but it's not as bad as it has been in the past. I think the reason that people are so sensitive to inflation is that we haven't really experienced any high levels of inflation going back 2-3 decades. We got to go back to the 1990s or the 1980s to experience anything like that. So our institutional memory has gone away. Now, you oftentimes hear about this core CPI versus the core CPI essentially takes food and energy out of the consumer price. And the reason you do that is that look at the core CPI, which is the blue line, and then the consumer price index, which includes food and energy. Notice that the core CPI is much more stable. They track each other, but they're much more stable. It's because food and energy prices are very spiky. They swing around a lot. So including food and energy prices can sometimes distort what's really happening with inflation. Okay, so that's why we kind of separate those two things out. Now, looking forward, the Conference Board is a group that does, they kind of monitor what they refer to as the leading economic indicators, and they report this monthly, and the most current is January 2025. And what they essentially said is that in January 2025, the index of leading economic indicators actually dipped down a little bit, kind of reversing the gains of November and December. Okay. Now, notice the blue line here. The blue line is the leading economic indicators. The black line is actually what's happening to the economy. Look at the time period 2022 to 2023. That blue line is trending downward. During that time period, there's a lot of talk about, we're heading into a recession. Okay, is it going to be a soft recession? Is it going to be a hard recession? Are we going to miss a recession? It was that downward trend there that was really drawing a lot of people's attention. Some of the particular indicators that kind of drove the decline in the leading indicators in January 2025 is average hours, weekly hours of manufacturing, consumer expectations for business conditions. There are certain things that kind of dropped that kind of led this. Okay, so let's look at some of these. Unfortunately, the university doesn't subscribe to the conference board, so I can't get the historical data on the consumer expectations for business conditions. I can't get that, but there is the University of Michigan Consumer Sentiment Index, which is a parallel. Okay, and you can kind of see it moving up and down, and it tracks recessions pretty well. But again, notice 2022, 2021, 2022, notice that it was dropping down. Okay, that's what a lot of folks were talking about. We're heading into a recession. But the recovery, it's trending back upwards. Okay, the concern is that the recent drop was one of the biggest drops it's seen in a long time. Okay, so there's concern that something is happening recently that are shaking people's confidence. If you look at the yield curve is another indicator, and it's essentially comparing long-term interest rates to short-term interest rates. Long-term interest rates should always be higher than short-term interest rates for a couple of reasons. One is you're paying back with money farther into the future. Inflation is going to eat that away a little bit, so the interest rate has to be higher up because of inflation effects. Also, risk. The longer you're making payments out into the future, the risk of something happening, like a war or a natural disaster, is higher. So long-term interest rates should be higher than short-term interest. When that flips, when the yield curve flips, it drops below zero, that's an indicator of recession. And going back, you can see periods when it said it dropped below 1 or dropped below 0, went negative, and a recession happened. Now look at 2022. It's down below 1. By all indications, it should be pointing to a recession. Okay, but notice that it's ticking back up again. Why didn't we go into a recession? Okay, this is again kind of that average hourly of productivity in manufacturing. You can see a similar type of pattern there, and that's dropped down just a little bit. Okay, now what about the stock market? This is 1 year. The S&P 500, and I'm including that because that's part of the leading economic indicators, and then the NASDAQ. This is 1 year. What's getting a lot of attention is what's been happening over the last couple of days. This includes yesterday. It doesn't include today. But notice that downward trend. That's what's drawing a lot of attention. Okay, is the stock market going into a correction? Is the stock market going into a sell-off? Is it doing this because of the uncertainty around policy? Well, you go back to July of last year, there was a similar correction, but yet we recovered. So maybe not. Now, this is the Wall Street Journal. This is the survey that they do, and I'm going to go through this fairly quickly because I think it's already out of date. They surveyed 75 different folks to kind of get their average. Now, the reason I like this is because the research suggests that if you grab any one of these individuals and you look at their forecast, the odds are their forecast is going to be wrong. But if you look at an average across all of these, that average is going to be pretty accurate. Okay. Now, I don't want to spend a whole lot of time with this because things have changed over the last month. But the forecast for gross domestic product was it was going to be positive. It was going to be around 2%, but it was going to be trending downward. That red dot, that's the average. The top of the bar is the average plus the standard deviation. The bottom of the bar is the average minus the standard deviation, kind of give you an idea of the range. Okay. Long term, again, the forecasts were all about 2%. Okay, so we were going to slow down a little bit, but 2% growth, no indication of a recession. Okay, the unemployment rate, The current average monthly unemployment rate for 2024 was about 4%. And it's going to be a little bit above 4%, but notice that it's trending downward. We think unemployment is going to be stable, trending downward a little bit. Again, the economy looks good, but this was in December and January. Okay, consumer price index, again, we think it's going to be trending downward a little bit. Is it going to hit that magic 2% that the Federal Reserve Bank wants? Probably not, but it's trending downward. Okay, the personal consumption expenditure, this is the one that the Federal Reserve Bank wants to look at. This is the one they monitor. And again, the forecast is it's going to be trending downward, but it's not going to be below 2%. Okay. This is, again, going out a little bit farther into the future, same type of pattern. I think with these forecasts are updated, and in about a month, when the Wall Street Journal releases the next one, I think a lot of these are going to, these forecasts are going to look very, very different. Now, interest rates. Interest rates, we think they're going to be trending downward, but again, this is a couple of months old. The federal funds rate, we think this is federal policy. This is what the Federal Reserve Bank is doing. What are they doing with interest rates? The idea is that they're going to be trending downward. The problem, though, is that over the last couple of months, the Federal Reserve Bank has backed away from this. Okay, in January, Federal Reserve pauses interest rates cuts. First meeting without a cut since July. They're basically saying, let's stop. Okay, we're not hitting that 2% goal. So let's slow down a little bit here. February, Jeremy Powell says there's no need to rush on interest rate cuts. Last Friday, Chairman Powell said the Fed is waiting greater clarity on Trump policies before making the next move on rate. They're hunkering. The uncertainty is there. Even the Federal Reserve Bank says we're not quite sure what's going on here, so we're just going to wait. If you get the Wisconsin State Journal, this is Phil Hand's political cartoon that appeared in this morning's paper, and it's this kind of on off. We're doing it. We're not doing it. We're not doing it. That's the uncertainty. That's the chaos that is causing a lot of this uncertainty. That's driving a lot of this kind of backing away. So, what are the odds of a forecast of a recession? This is again from the January 2025, about a 20% likelihood of a recession over the next year. Now, I want to show this because this is the same survey question that was from October of 2024 compared to January of 2024. Notice that in October, the odds of a recession was about 1 in 4. In January, it dropped down to about 1 in 5. That's that indication. Remember the headlines of looking at 2024 or 2025 were generally looking good. Okay. Economic forecasts were generally looking positive. That's all changed. Okay. So what's the immediate economic outlook? I put a question mark in there because over the last 2 weeks, it's changed. The idea was it was going to be slow and steady, reasonable unemployment and inflation rates, and downward pressure on interest rates. Given the last 2 weeks, given the last month, I'm not sure. Okay. Two of Trump's potential economic policies, tariffs and mass deportation, could threaten the positive economic outlook. The tariffs is what we're seeing. Okay. The mass deportations is going to take longer to play out. Okay. The wild card is the policy uncertainty. That's the chaos. And that's what's undermining the economy right now. And I will stop there. And I think I probably went a little longer than I should have because we wanted to leave time for questions and comments at the end. So I wish I could say, yes, the economy is roaring. We're doing great. If you'd asked me that in January when I did a similar workshop, I would have said, yeah, the economy looks really good. Today, I'm not so confident.
Thank you very much. Lots of great information there. We've had a couple questions coming through the chat, and I'd encourage everyone, if you've got questions, please chat them in so I can get them to Stephen here. First one, you'd mentioned that Canada is one of the largest trading partners of Wisconsin. If these tariffs continue in place, where do you think we'll see that impact in Wisconsin? In any particular industries or goods or services?
I think we can see kind of like what's happening with the aluminum and steel tariffs right now, how it's actually playing out. That's been in place for a while, and the Biden administration has kind of kept it in place. The Trump administration is looking at increasing it. And one way that that's playing out in Wisconsin is in food processing. We, in the Central Sands part of the state, we produce a lot of vegetables. A lot of those vegetables are frozen or they're canned. The cans use steel. That steel comes in from Canada. That part of the Wisconsin food processing industry is really struggling. A major reason they're struggling is because of the cost of the cans that they put the vegetables into. It costs more for the can than it does the vegetables. That's an example of how a tariff, as one specific tariff, is having a specific impact on a Wisconsin industry. Now, how it all plays out is really where a lot of the uncertainty is, because we don't know. One day the tariffs are on, the next day the tariffs are off. The other thing is we don't know how. Let's say with the Canadian example, we don't know how Canadian consumers are going to respond. There's a lot of examples in the media right now of Canadian liquor stores essentially taking all U.S. liquor products, beer, U.S. beer and wine, and basically shipping it all back to the U.S., saying we don't want it. So if you go into a Canadian liquor store, you cannot buy U.S. product. There's no tariff. But what's happening is that the Canadian consumers are basically saying, fine, we don't want your product. Okay. So there's all these kind of things that are happening that are next to impossible to forecast. We can't predict how Canadian consumers are going to respond. We can't predict how Mexican consumers are going to respond. So that's the uncertainty. That's we don't know what's happening. That's back to the Donald Rumsfeld. We don't even know what we don't know. So that's what's causing the concern about the future of the economy going forward. So I wish I had a clean answer for you, but there's too much unknown right now.
Sure. If we are or enter a period of some sort of economic downturn, any suggestions you have for businesses, especially closely held, family-held businesses or individuals, to get themselves ready for that and to be prepared for that?
Do as much financial planning as you possibly can. Sit down and really kind of look at where the business is going looking at least a year out into the future. I think that it's really important to kind of stop and take stock on where the business is right now and where does it look like it's going to into the future, and then prepare a couple of I don't want to say, I sound like the sky is falling here, but you may want to play out a couple of worst case scenarios. If this happens, how are you going to respond? If that happens, how are you going to respond? What's really important for you to remember is to keep in mind what you have control over and what you don't have control over. Okay? Dairy farmers. I don't know if there's any dairy farmers on the call, but dairy farmers like to complain about the price of milk. They have no control over the price of milk, none whatsoever. They can introduce contracts and things like that. They can minimize some of the risk with it. What do they have control over? They have control over their cost of operation. So while, keep in mind things that are beyond your control and things that are in your control, and focus your energy on what you have control over. That's where you want to spend your time and energy. Be aware of these outside factors, but try not to lose sleep over those. Put your time and energy into what you have some control over.
Say one more for you. outside of Wisconsin, do you think, what industries do you think would be most impacted by any economic downturn?
Large capital expensive items, the auto industry. The way that the auto industry has integrated its supply chain, the fact that buying a car is an expensive proposition, I think that that industry is particularly vulnerable. I also think that the housing sector is particularly vulnerable because of the cost of construction. Um, I work with a lot of communities across Wisconsin around housing issues. And, a lot of these communities say, well, why can't we just get people to buy, cheaper housing? And it's like, you can't make any money because of the cost of materials. You can't make a profit given the cost of materials. Um, if we go into a trade war, the cost of materials is going to get even more expensive. Lumber, how much of our lumber comes from Canada? Gypsum, the material that goes in the drywall, most of that raw product comes out of Mexico. So we're going to be looking at um, the construction industry getting hit really hard. Um, Housing prices right now, if you think housing is expensive now, um, new housing is going to become even more expensive. So certain industries are going to be more exposed, and the bigger ticket items are the ones that are going to be most vulnerable.
That is it for what I see for questions. So as we wrap up here today, I'd like to point out for everyone that you can go to svaccountants.com to sign up for our tax alerts, biz tips, other webinars like this. And then there are also lots of other resources out there to help you. Keep in mind too that the SVA team is only a phone call or an email away. If you're a client, please reach out to your SVA professional as questions arise. And if you're not currently an SVA client, please contact me, Lee Schwartz, our business development sales director, or anyone in our business development group so that we can get you help with the answers you need. Thank you again, Dr. Deller, for your wonderful presentation today, and thank you everyone for attending.
If I can add one more thing, Matt,
Please do.
as you were talking about um, as these uncertain times fold out, tap into your network of professional suppliers. The other thing is tap into your network of peers. If you belong to a business association, um, become more active in it. And I don't mean active like becoming a leader, but I mean kind of. I don't want to say it's a support group, but tapping into your peers, even if they're your competitors, they're still your peers. Tapping into them can be one, a support group, but secondly, a valuable source of information. So take advantage of those networks. And that includes your professional service providers, your banker. I'm sure your banker would, I mean, most bankers, if you want to sit down and have a conversation with them, they'll talk to you. And if they're not willing to talk to you, find another banker. But reach out and try to find that support that you need. And with that, I'll stop. Thank you, Matt.
That's great advice. Thank you again, Dr. Deller. Thank you for everybody for joining us today. Hope you have a wonderful rest of your day and rest of the week. Take care, and we'll see you hopefully again soon for another webinar.